Welcome. I'm Bill Gunther. I'm president of Mass Insight Global Partnerships. Based in Boston, Mass Insight organizes public-private collaborations between universities, industry, and business, both in the New England region and beyond. We're very pleased to continue our collaboration with Ropes and Gray on this Data Insight series of webinars, and to have all of you participating in this exciting session on ESG today. I also want to thank Northeastern University's DeMoore McKim School of Business for their continuing participation and sponsorship of this webinar series. I'm going to introduce Josh Lichtenstein, who is head of the ERISA practice based in New York for Ropes and Gray. Josh will moderate the discussion, introduce the other panelists, and I know engage in a very lively discussion about the ESG challenges in the pension fund and state investment world. This session is being recorded. The recording will be circulated to all of you and to those who couldn't participate but signed up after the session. You also have the opportunity to ask questions. Use the question button. They will be channeled to Josh as moderator, and as feasible, he will incorporate those into the discussion. So without further ado, Josh.
Thank you, Bill. Thank you, everybody, for joining us here today. We're incredibly excited about the lineup of experts that we've assembled to discuss this really interesting topic. Just very, very briefly, as Bill said, I'm Josh Lichtenstein, and I'm the head of the ERISA fiduciary practice here at Ropes and Gray. And I have been increasingly finding that I've been spending more and more of my time really focusing on the state ESG issues that we'll be talking about today, because they've come to dominate so much of the discourse around how state pension assets are invested, which has been very, very important, to many of our clients in the asset management industry. I'm joined today by John Struer. He's the president and chief executive officer at Calvert Research and Management. He has a long history of working in the ESG investing space and great expertise, and has worked in depth with various trade groups and with regulators to help to sort of define a lot of what the current environment looks like from a regulatory standpoint, and to help their clients to navigate these difficult spaces. I'm also joined by Kevin Chaw, an assistant professor of international business and strategy at Northeastern University's DeMoore McKim School of Business. He's a research fellow also at the Wharton ESG Initiative. And Kevin's research, it's very interesting in the way that he's examining how shareholder activism has influenced firm strategies, especially in relation to ESG issues. And before entering academia, Kevin worked extensively in the private investment management industry, including as a portfolio manager at BlackRock within the multi-asset strategies group. So he brings both the academic perspective and the perspective of having worked privately in the investment management space. Finally, I'm joined by Patrick Templewest. He is a governance reporter at Financial Times. He's been covering ESG for the last 4 years and has extensively been covering other political topics for many years before. Patrick has really been focusing on some in-depth behind-the-scenes investigative reporting on exactly what's been influencing some of the trends that we're seeing in the ESG space. And so he can help to shed light on how we should understand what's really happening right now. Before getting to the panelists and some of the questions that I have for them, and I have many interesting questions, I just wanted to flag, as Bill said, that if anybody else has some questions, please feel free to include them in the Q&A feature, and I'll do my best to ask as many of them as possible. This is, I think, a really great time to have this discussion. In addition to the huge flurry of activity that we saw during this legislative session among the red states, many of those legislative sessions have ended or are ending now. We also see a lot of activity going on at the federal level. As many of you may be aware, just yesterday in the House of Representatives, they kicked off ESG month, where they're talking about many of these topics. And that might not have been on many of your bingo scorecards for what we might have expected the House of Representatives to spend an entire month focusing on with the various different topics and investigations ongoing there. But it really helps to illustrate how important and how top of mind this topic has really become on a really very, very mainstream level. And in the last few years, we at Ropes and Gray have been tracking, through our state tracking website and interactive map, which many of you may be familiar with. We've been tracking everything that's been going on in the states, and what we've seen is a really marked shift in the retirement landscape in states. Historically, the rules that state retirement plans had to follow, right? These are the plans that are governed, that are sponsored by the states for state employees. And historically, the rules that they followed were pretty uniform, and generally very, very heavily patterned on the federal rules, which apply to private employers under ERISA. What we've seen, though, in the last few years is a marked shift in many, for some blue states, but also increasingly red states, away from just following what has been the traditional, this sort of traditional adherence to ERISA-like doctrines. And so, notwithstanding the fact that all of these state plans investments are really governed by, notwithstanding that they're really, governed by the same sort of fiduciary requirements of, fidelity, prudence, loyalty, which are, the highest generally recognized under U.S. law. What we're seeing now is many of the red states reinterpreting those same words to not, to still have this idea of heightened prudence and heightened loyalty, but also with this added gloss that actually acting in accordance with prudence and loyalty means considering some things, but not considering some other things. And, crucially for this discussion, not really including, consideration of many ESG factors. We've seen a few different types of approaches within the states, which I want to quickly just outline before turning to questions. Some states we've seen, and this was some of the earlier states, they've adopted what I like to call sort of an anti-boycott or boycotting regime, where what they do is they'll come out with a list of financial institutions which they've determined based on a combination of responses to questions that they actually send directly to financial institutions, publicly available data, and other information that they solicit. They'll determine that certain financial institutions are boycotting certain protected industries. That's generally going to be the fossil fuels industry and or the arms manufacturing industry. And then they'll determine what list of financial institutions they believe are boycotting, and then you get forbidden from doing business contracting with the state. Texas was the first state to take that approach, but a number of states have taken that approach. Most recently, Oklahoma came out with their list of institutions which are banned. And it's not the entire breadth of ESG that's the focus here, but if you're put on this list, obviously it can have pretty material impact on your ability to do business with the state. The second category of actions that we've seen, and this has been more common, much more prevalent, I would say, is we've seen states that have really changed what it means to invest. And what they've basically said is the investment criteria that's acceptable has to only be sort of material financial factors, and they don't allow consideration of anything that they determine to not be within this sort of universe of the term pecuniary factors. And that's a term that that mirrors, it's a term whose origin actually comes from the Trump administration Department of Labor's rule that governs private pension plans. And while on its face it might not seem like it would be that impactful on ESG to just say that you can only consider factors you believe are likely to have a material financial impact on investments. The term is understood to carry this very heavy assumption that ESG factors are unlikely to meet that test. And so it's really the context that is most relevant, perhaps not the actual language. The third type of action we've seen is a number of states have taken actions to to divest from a single asset manager, having determined that the values that that asset manager represents, either through its investment or proxy voting activities or both, is incompatible with the best financial interests of the state. And so we've seen states announce divestments. It can be difficult to know exactly what's really changing or where, because even just understanding what's been adopted in terms of statutes often isn't enough. There are a lot of sub-regulatory activities as well. There's, we see state attorney generals announcing positions, we see state treasurers announcing positions, we see changes to investment policies that these retirement plans have to follow. And each of those things can have a really big impact on the way that those retirement plans get invested. Or not, because even where we see that they've adopted a law, it doesn't necessarily follow that the investment professionals working for the states investing those assets will quickly make big changes or even tend to make big changes at all. They may want to continue to invest the way they've invested for years, really believing that ESG data is very important as part of the investment process. But in many of those cases, we'll see them seeking to shift the risk of staying the course from themselves onto the asset managers that they're hiring. So it's all very, very relevant. It's very important for everyone to understand. And then the other aspect I want to just briefly touch on is there's also the enforcement story. And that's something that we're really seeing heat up. Not necessarily reflected, not something that's obvious just from looking at what happened in the legislative sessions in these states. We're seeing a really coordinated effort from a number of red states to ask actually the same questions of a lot of different asset managers. And it sort of highlights that what you actually do and sort of approach that you have is very important, but the way that you talk about some of these issues can be very important as well. And so ultimately, I think that when we look at the totality of what's going on, the conclusion is it's a challenging environment, rapidly evolving, hard to know exactly what to do, very few bright lines other than the bright line of being put on a boycott list and knowing you can't transact with the state anymore in most cases. And so that's really why we've invited this expert panel today to try to help our audience to understand how best to navigate this incredibly murky, difficult, and ever-evolving landscape. So with that, John, I'd like to address my first question to you. The debate has really been framed as one about, how state money can be invested based on, if you can consider everything, or you can only consider those pecuniary factors that I was mentioning. But that the debate itself seems to presuppose that there's this like big divide in the investing world between managers that are investing based on just what's, best from a financial standpoint for investors versus managers that are focusing just as much or even more on driving non-financial ESG related goals and outcomes. But is that really what the investment world looks like, or do you think that this is more of a straw man?
Thank you, Josh. And first, I want to say that the concept around pecuniary factors has, of course, been somewhat of a bedrock in ERISA, and also, frankly, somewhat of a bedrock in SEC guidance for issuer disclosure of materiality, to investors. So, in fact, I think it is more of a straw man. And I think your question, as I take it, is, are there lots of investment management firms managing institutional assets that are making decisions based on things that are non-pecuniary? And the answer is really no. I think all of us are very focused on producing competitive investment results, producing competitive financial returns. That's what our clients hire and fire us based on primarily. So the concept that there are lots of investment firms out there who are attempting to impact social policy or environmental policy without regard to the impact on investment results or the impact to corporate results isn't really something that we observe. So I would say, Josh, it's much more of a straw person, than it is a reflection of the reality of what's happening in the industry.
Thanks, John. I mean, that makes a lot of sense because, like you said, you're not going to get hired or probably won't be retained very long if you're not actually driving, good returns for investors. But do you think that there are really even in the, just focusing on the universe of impact funds, do you think that there are many impact funds out there that would really say they aren't really seeking investor returns and are really just investing in order to advance those sorts of ESG goals? I mean, I know it's not going to be a huge slice, but do you think that what they're aiming at really exists at all?
Correct. I think there are very few, especially today, there are very few impact-oriented investment firms that are not focused on creating positive financial returns. I'd go one further. I would also say that there aren't a lot of companies, even operating in the impact space, that don't focus on running a successful business. And I think that's that's another critical point. When we think about what's happening from the investment management perspective broadly, or with the impact space, I think it's very important to also have a perspective regarding what is happening at the companies that we're investing in or the companies that we're analyzing. And today, I think both investors and the capital markets broadly expect all companies to be able to conduct their business, whether it's impact oriented or not, in a manner that will create a positive return. So again, Josh, your specific question, are there a lot of impact funds that aren't paying attention to financial returns? No, there really aren't. And additionally, the expectation is that even within kind of the impact world, which is a very narrow slice, by the way, return on invested capital is a focal point.
Yeah, I mean, it's a great point. And one of the things, and I know we'll talk about this more as we continue the discussion today, but I think the vocabulary is a big part of this debate. And I think that a lack of good, consistent vocabulary between some of the people that are actually making these rules versus the industry, is causing some confusion and maybe creating some of these problems. But one of the things that I think is one of the big terms that's so common in the industry, but we really never see mentioned by the states, is the idea of sort of concessionary versus non-concessionary returns. And do you agree that that's one of the challenges here, is that people aren't sort of speaking the right language of explaining what it is they're concerned about in terms of management of the state pension assets? And maybe if they were, it'd be easier to figure out, is there really anything we need to be worried about investing in?
You bet. And I think just briefly, concessionary returns, of course, are defining investments where the investor has willingly taken a below market return in order to create some kind of a beneficial outcome. And of course, that is much more the domain of philanthropic investors and some high net worth investors. It's really not something that we would expect to see in a state pension fund, or certainly in an ERISA plan. And so I think that's the definition that we're looking for. And that is not really something that we see in this domain at all, investments that are designed around concessionary returns. And again, even in the impact investing space, which has matured significantly over the past decade, today there's a good percentage of the impact investing space that seeks to produce market competitive returns, as opposed to simply concessionary returns. There's definitely still a component that takes concessionary returns, but again, even in impact, there's a significant cohort looking for market competitive numbers.
Yeah, I mean, that makes a lot of sense. Now, I think that one of the big points of contention that we see in the debate is really about exactly, going to what you were saying, John, how these funds are actually performing, whether impact funds or whether funds that are just using ESG as part of integration. and how considering ESG data is actually impacting the returns. Kevin, could you talk to us a little bit about what do you think the best answer is on sort of where we are now in analyzing how how ESG data is doing in terms of financial and returns?
Sure. So there's been lots of studies, both in academia and also from market practitioners as well. Hundreds, if not thousands, of studies, and they suggest that at worst, incorporating ESG data doesn't detract from financial performance on average, but actually, in fact, the vast majority of this analysis and these studies indicate that incorporating ESG data actually improves financial performance for companies and investors, reduces risk as well. And the question then becomes, well, why is that the case? Why just incorporating this extra piece of information actually reduce risk and have at least a non-negative effect on returns? And I think of three things when it comes to this. Firstly, ESG data tends to be a proxy for management quality. So, for example, if you think of the G in ESG governance, right, we care how executives are paid, whether they're paid too much, right? That's a pretty traditional, I'd like to think that's a pretty traditional factor now, but that falls within the alphabet soup of ESG, also board oversight, things like that. Secondly, is that ESG data is sometimes used or often considered as a risk factor. So if you think of climate risk, which has traditionally not been viewed as financial, well, I tell you what, if you're a company in Vermont right now, you're probably thinking that climate risk is a financial risk. So issues do change in terms, and especially these issues do change in terms of what is and isn't viewed as financially relevant. And then the third factor, the third channel, is that ESG data often gets used as a proxy for a company's reputation with customers, with communities, with other types of stakeholders. So if I'm an active investor, I would want to use ESG data to get as much of an informational advantage, informational edge as possible, so that I can understand, well, do these factors actually help me get at a better understanding of the quality of management, the reputation of the company, and the different types of risks that those companies might face. And just actually going back to the point you made before, that John made before, in part of my research, I actually looked at many of the prospectuses of ESG funds, right? It's something that I advise most people not to do because it's very boring. But you'll see that for any of those funds that are trying to sell into the ESG space, they are including that our primary objective is financial performance, right? And it just so happens that incorporating these ESG factors helps improve our performance and also better manage our risk.
That's a really good point, Kevin. I want to pick up on what you said about signaling out sort of the G in ESG, because I think that's a really important point as well. Because I know some people tend to think about ESG sometimes as being a little bit of maybe softer factors, particularly in the S side. But the governance is such a core part of regular investing, I would think, that I always think that it's sort of fascinating that people say, well, ESG can be a problem, or ESG it shouldn't be something that should be considered. Because it's just hard to imagine that many professional investors are actually out there in the world saying, well, we're not really concerned with corporate governance. And I was actually, it's funny, I was talking about this once not that long ago with Ali Kwar, the acting assistant secretary of labor in charge of EBSA. So he's really responsible from the ERISA side, a lot of this rulemaking. And one of the things that he'd said was just, that he's always sort of dumbfounded when people, object to ESG as a whole, because, he's not really sure how any fiduciaries to retirement plans are actually properly discharging their fiduciary duties of prudence and loyalty if they're not considering corporate governance of the companies they're investing in. So now, sort of continuing along the sort of, just setting the table for the discussion, we all see what's in the headlines, right? And we see the formal actions, and anybody who's using our website, sees on the map all the states that have popped up in the different colors. We see what's going on publicly, but it can be hard to understand, I think, sometimes, the entirety of the debate because we don't see everything that's happening, right? Especially what's motivating the movement behind the scenes. Patrick, I know you've done a lot of work in this space and you have a lot of insights into what's going on. So I'm just curious, what do you see as some of the main forces that are moving behind the scenes to influence what the red states are doing now?
Thanks, Josh. The main forces, it started, the ball really started to roll down the hill in 2021 when we had the engine number one fight with Exxon, which was seen as a Sputnik moment in the conservative movement, how this tiny hedge fund that nobody had heard of, the minuscule stake in Exxon, could get BlackRock and other large asset managers to vote for it and vote people onto the board. Really shook up the board level, the corporate executive landscape, especially if you are in a fossil fuel company or industrial company that is not as green as sort of some of the cleaner tech companies out there. And of course, this all came as there was a changeover in the administration, 2021, Biden, the Democrats were starting to bring in their people, putting them in the SEC, immediately started asking questions about climate disclosures. So as ESG and ESG investing had always been going on in the background, now some of the largest players in the conservative movement were taking interest and really raising concerns about this. One of them who has been a big donor and vocal opponent of ESG is Leonard Leo, who's co-chair of the Federalist Society. We know the Federalist Society mostly for being the conservatives' bench for Supreme Court justices, but they have gatherings and it does a lot more conservative think tank work in addition to Supreme Court justices. So there has been a lot of talk among high net worth conservative circles about ESG, about this corporate woke movement, which is separate from ESG, but also part of ESG. So there is this, again, ball rolling down the hill of concerns about this. And now what we're seeing at the state level, at the federal level, this ESG backlash is designed to counteract what the conservatives would see as the left taking control of this niche in finance and the corporate landscape. I mean, I've been told specifically that the Republicans feel they've been asleep at the switch on sort of the proxy battles, the shareholder proposals, things that John know well, that the left has, and we've written about this, and definitely cool about whether that has been very productive at sort of changing corporate behavior, but the right definitely feels like they've been asleep at the switch. So now we are here in this moment in July 2023, where states have boycott lists and the House of Representatives is dedicating a month to ESG.
Yeah, and I mean that's really, really helpful and useful background. You think that it's a lot of the same forces that are sort of both behind what's going on within the states and also what's going on federally, like in the House right now?
Yeah, the Federalist Society, these large corporate donors use, and the left does this too. So it's not particular to Republicans, but they're sort of the ones we're talking about today because they're generating on ESG. They give campaign contributions to state levels. The Republican attorney generals, they have an association that takes money and distributes it to its members the same way that the Republican governors, Democrat governors have fundraising vehicles. The House of Representatives, obviously, they're up for re-election every 2 years, so they're constantly in fundraising mode. So a lot of this is to show that they are active and agitating against ESG so that they can continue to get campaign contributions when it matters.
I mean, it's such a fascinating dynamic. And, I think that, everything that you're saying, it really sort of it leads one to say this isn't necessarily a battle among 50 different states about what the rules should be, that there really is very much this sort of national fight playing out where there is a lot of alignment among the red states and Republican politicians in the federal government. But then there's also but then there's also sort of as opposition, not necessarily the ad hoc blue state, but things that we're seeing from the federal government under the Biden administration. And I think a good example of that actually is where we see all of these multi state attorneys general actions where they'll sign onto a letter together to try to influence a particular organization. We're talking about proxy voting in a moment, but we've obviously seen some real collaboration among states there, and it seems to feed into some of what's being discussed at the House right now in their hearings for the ESG month. And I think maybe one of the most interesting culminations of all of that is what we see playing out in Texas right now, where we have 25 state attorneys general actually suing to try and get the Biden administration's ESG rule for private plans invalidated, notwithstanding the fact that that rule obviously doesn't limit the ability of the states to impose limitations on how their own retirement plans, their public assets are invested. So just a fascinating dynamic, I think. So now I want to engage in a little bit of a thought experiment, right? Because it's unclear exactly how much impact some of these things that are occurring from the red states and Republicans in the federal government are going to have. But let's assume that there is a really big impact from everything that's happening, right? Let's assume that the threat of the loss of being able to manage the red state pension assets is really realized, or let's assume that there's a big chilling effect that comes from what's just the debate occurring at the House, and there's worry in the industry. Kevin, what do you think that the world would look like in that case? What do you think would really happen to the market if there started being sort of real limitations on the ability to use ESG data, or managers started diverging more, with some managers gravitating in sort of to become sorted as red state managers, or some being sorted as blue state managers?
Yeah, I think there's a few different ways this could play out. So firstly, if you're an asset manager, or if asset managers get banned from using ESG factors, then you're effectively reducing the supply of investment managers that can operate in your state. And so effectively you're then reducing competition. And, we know from Economics 101 that when you reduce competition, that means that prices can go up. So the fees that are charged by the asset managers that remain can go higher because they don't need to compete as much on price. And then that obviously hurts performance of pension funds. And we've seen this play out already in the municipal bond market. So for example, there's a study by Daniel Garrett from Wharton, who's also part of the ESG initiative, about the increased borrowing costs faced by municipalities in Texas because of certain banks not being able to lend into that market anymore. Another way that this could play out is that if for those asset managers who aren't put on a banned list, right? So for those who are still okay to operate in those states, they might actually voluntarily leave those states because they're worried about falling foul of any laws. So one risk, which I haven't seen talked about that much actually, is that asset managers might inadvertently open themselves up to litigation, because to comply with these rules, they might need to ignore financially material information, right? And that might not necessarily be in the best interests of their clients. So a bit of an unintended consequence potentially there. And then I think more at the market level, overall investment market level, what you might find is that when you think about some of these ESG factors, ESG data, they tend to proxy longer term issues. So by incorporating those factors, you tend to think more about how do you invest for the long term. So things like climate, employee relations, community relations, things like that. So another potential unintended consequence here is that if you ban the use of ESG data, it might actually encourage fund managers mutual funds to become more short-term in their orientation. And that could lead to more market instability overall. So bit of speculation there, but a couple of different ways that things could play out there.
That's really interesting, Kevin. The point about the lawsuits, I think that's in particular interesting because, when we see that what the states are doing, right? And we've seen this in Texas, we've seen this in other states, that they've made it express that there isn't an ability to sue the state over having restricted the universe of investments. But it's a fair point that doesn't really mean that there couldn't be lawsuits brought against the asset managers privately. And even if the participants in the state retirement plans aren't the ones who could do that, if you see a shift in overall investment strategy because of the influence that's been exerted by the red states, then yeah, you could imagine a world in which I suppose you see some sort of class action lawsuit being brought against an asset manager alleging that they've started like sort of systematically ignoring data that peers are considering, or otherwise sort of failing to discharge fiduciary obligations, especially in the retirement space, by failing to consider all of the relevant data. It's a really, really interesting point. And it would be interesting to see how that was to play out. We got a question from the audience, which is really sort of directly related to this. And I want to pose this, Kevin, please, take a shot at it, but everybody, be curious for your thoughts on this. So sort of separate and apart from the fact that we see, like as Patrick was describing, we see all of this sort of very active fighting against, causes that are unpopular, with the Republican donor base and with some influential individuals and organizations. That there's also this sort of dynamic about fear of what consumer backlash can look like, and like for example, the Bud Light moment, right, and the material impact that's clearly had on the business. And so I think that it can be challenging for issuers, but also for asset managers to sort of navigate this. How do you balance, wanting to make sure that you are sort of, doing right by all of your investors, with the fact that we know that there is so much polarization right now, and that there's the risk that, any given surprising action can trigger a backlash from one side or the other that could actually really shift market values.
That's just a quick take from me. It's a really challenging one, I think, for asset managers, because I don't think most of them don't want to be playing this game, right? They don't want to have to deal with these, add this to their list of criteria of what they're actually doing, in addition to what they've already agreed with their clients, their existing client base. So from that perspective, you might find asset managers falling foul of this and getting targeted. But I think for most of them, they'd rather, and maybe John's better placed to answer this, but I think most of them just want to get on with the work of doing their best at managing their clients' money.
Kevin, I certainly agree with your comments, and Josh, to your example and kind of the broader point, I'd make three quick points. I would carefully separate a company's need to react to kind of social trends and social changes that are happening in the world around the company. I'd carefully separate that from the topic at hand, which is managing investments and using financially material ESG information in the management of investments. So companies constantly have to adjust to changes that are happening in the world around them, in terms of what society wants and what social trends are. That's a management need. That's a management skill. Certainly a consumer product company needs to have that. Rarely would we expect a company to attempt to change a social trend. They're reacting to it. So I do want to make that point. And that is also a different issue from what we do in the investment world, where we are attempting to use material information that the company itself has generally disclosed in its regulatory filings under longstanding SEC guidance related to the disclosure of material information. So I want to just kind of carefully separate the example that you used from, I think, this case at hand. I'll make the point, though, that this isn't always being properly separated in the current discourse, right? I think there's conflation happening, there's confusion happening. And then the third point I do want to make is that, as we potentially move into an environment where, there are potentially new rules, or certainly the concept of new rules being created, from an investor's perspective, process is extremely important. So one of the things that's common in the DOL rule, frankly, the DOL rule under Trump, the DOL rule that Ali and the Biden administration created, and all of the current discourse that we're discussing here, is a concept that evaluating a company based on pecuniary factors, based on financially material information, really is an expectation that an investment manager will undertake. So I think that the process that an investment management firm uses to document their analysis of ESG information, to prove up the basis that they have for suggesting that it's financially material, the link into regulatory documents created by the issuers that are being analyzed are important. And these are important, features for investment managers to focus on in any aspect of ERISA management or any aspect of investment management. So I think in many cases, kind of the same rules hold in terms of dealing with this set of issues that hold in dealing with the standard of care, prudence, fiduciary standard, kind of across institutional investment management.
Those are all really, really great points, John. Thanks for all of those reactions. I want to pick up on you said for that specific example that sort of like that's really not what we mean when we talk about ESG, and it's a great point that because it's so short term, it's reactionary to an of the moment, social trend. But and maybe this is a question more for Patrick than anyone else, but welcome others' thoughts. Do we think that, I mean, how much of this sort of conflation of like, so-called anti-woke ideas and ESG is really sort of unintentional or a matter of lawmakers not really understanding the what the terms mean and what the debate really is and the framing, or versus how much of it do we think might actually be sort of intentional? Because the ESG and woke are both terms that sort of are having a moment right now in public discourse, and when you combine them together, maybe it just sort of has a force multiplier impact of anything you do. If you can say, oh, I'm fighting ESG because I'm anti-woke, which obviously we all know that that is something that Governor DeSantis has been saying quite a bit on the campaign trail. To what extent do we think that maybe that is actually all intentional?
I think it's the latter. Yes, I think if you are looking to beat up on ESG and keep companies from prioritizing this and making fundamental changes to business behavior that might be costly in the short term but beneficial in the long term, that's definitely being conflated. I mean, I do know that we had a whole series of board directors in not too long ago, and it was on Chatham House rules, but the question came up of, it's a big topic of conversation about what to do in this anti-ESG corporate environment, and nobody really had an answer to it. Nobody really knows how to avoid being Disneyified, the verb that they created. And these are like the board directors that they have the best consultants, the best law firms, and they're paid to think about this, and nobody really has an answer except just keeping quiet about it. So it is whether or not it's being conflated, anti-woke, ESG, it is scaring the bejesus out of companies. You can quibble over, well, are you a brand company or are you a more behind the scenes company that isn't going to get written about in the FT or other publications? That's fair, but still, it is a reputational headline risk that that companies now really have to deal with.
So in the asset management world, then, I mean, I guess the question is really, should we be thinking about reacting to the anti-woke movement separately than thinking about the reaction to sort of like opposition to net zero and more core ESG concerns?
Well, it's the same thing in asset management. I mean, as I'm sure you're aware of these conversations, nobody wants to be boycotted. It's just not a good look. Even if you're not doing business with Oklahoma, you really don't want to be on those lists. And it doesn't matter so much for JP Morgan, Wells Fargo, some of the other banks the other giant 3 or 4 banks that are on there, but it does matter for those mid-sized private equity, venture firms, other wealth managers that don't have the size. And maybe you're not in Oklahoma now, but if Oklahoma suddenly becomes next year, Oklahoma, Louisiana, and Alabama are now divesting from you, that suddenly becomes a bigger and bigger problem. Or I think it was Kevin who mentioned the municipal bond market. If you're limited in doing business in these red states, that just it adds up, and that's a piece of your book. So I do know, and asset managers, the people who do ESG and the sustainability directors at these firms, I mean, this is what they're struggling with every day now, is how to talk about how to do sort of the red sleeve for the conservative states and the blue sleeve for the liberal leaning states.
Yeah, and I mean, then the question really becomes, I think in large part, how like that works, maybe that works now in this moment, but long term, what's the viability of continuing to say that unless you're running really different strategies with really different teams and, different apparatuses for determining the universe of potential investable companies, at some point, I think that in most cases, most asset managers would have to say, whether we expressly toggle certain parts of ESG screens or not, there's certain portions of it that are unavoidable just because it's part of either sort of what we think is the actual, economic proposition of all these investments. We don't believe that certain industries, represent good long-term, opportunities. And so we're not going to consider them within our diligence set. And that may make perfect sense from a business standpoint, but it may also look to some of these red states like boycotting those industries, right? So it's really challenging. And on that point about the boycott lists, one thing I don't know how others on this panel felt about this, but I had initially thought that the first list that came out was going to be much larger than it was, because they asked so many asset managers for responses, and I think that there aren't necessarily a lot of differences in some cases between some of the ones that were included and some of the ones that they didn't include. And as we've seen other states stop lists, the lists have, also they've all been somewhat restrained in the size of the lists. And I'm really curious to see as we move to sort of like a round 2.0 and we see, potential revisions to these lists. And we've already seen Texas add one more institution, of course. If we wind up seeing larger and larger lists and what that winds up sort of looking like, and the impact that it winds up having on managers. Of course, there's no way to predict that right now, but it is, I think, something that's I think it's really important to not become complacent with the current state and assume that each state that has a boycott list is going to have somewhere between 11 and 13 institutions, mostly large institutions, and non-US focused institutions. Right. In fact, the Oklahoma list you mentioned, Patrick, right? It's fascinating for a number of reasons. One of which is that it includes managers on it that aren't publicly traded, even though the definition that triggers the inclusion on the list is supposed to only include publicly traded institutions.
Oh, really? Interesting. So, I mean, there you go. It's like if you need to draw up a list of boycotting firms, you find firms, right? I mean, you just have to put people on the list. gets a little.
Gosh,
absurd.
one thing I'd point out on this topic is how dynamic both industry is and how dynamic investment decision making is. And I would we're talking right now about the concept of an investment manager boycotting an industry and therefore being potentially excluded from managing money in a state, and maybe specifically we're talking about does a manager boycott the oil industry and therefore is potentially excluded from managing money in Texas? It's a very dynamic world. Today, we see Exxon suggesting that they're interested in buying Denbury. Denbury is a company that is primarily involved in or is of interest because they have infrastructure that will transport carbon for carbon capture and underground sequestration. So here we have a Texas company or a company that's got heavy exposure to Texas in the oil industry, taking a corporate action to potentially mitigate its carbon emissions. And as an investment manager who may, and certainly Calvert doesn't boycott anything, by the way, but if an investment manager had previously boycotted Exxon or a company in the oil industry, they're going to have to take a second look at things, and they're going to have to, question whether that was a good decision or not, because many oil companies are themselves evolving and they're adjusting to circumstances around them. So I think it will be very difficult for investment managers to maintain kind of a competitive footing with a hard-coded boycott. I do want to just point out how dynamic this really is, both on the industry side and the investment management side.
That dynamic nature, that it's a really great point, John. Actually, to follow up on that, right? It's because I guess it comes sort of on both sides. It's hard for you to really do your job if you're saying, well, we're going to ignore companies because historically they might have done poorly on ESG metrics because companies can change. But on the flip side of it, and a lot of what we see the red states pushing for, right, if we're or seeming to push for, what would the viability even be of really trying to say, look, we're just going to take ESG data out of our investment decisions, especially given, and I know you mentioned this before, we know the SEC already has views on what's material and has to be disclosed, and there's a lot of disclosure under current materiality risks. So can investment managers really comply with their duties, especially the pension plans, if they are ignoring what's sort of already posited to be material data?
I think it would be very difficult. And again, I think that what we've seen from the Republicans is they have parsed this issue fairly well, because what they have said is non-pecuniary ESG data or non-material ESG data. And of course, what so many investment managers are focused on is pecuniary information or material information. And of course, the SEC, bedrock is that issuers need to disclose material information that's of use and of importance to investors. So I actually don't think anyone is asking investment managers to eliminate material ESG information once the pen actually hits the paper. But to your specific question, if investment managers were asked to ignore material information, and let's just say the definition of ESG is broad, yeah, that would be very difficult. That would be unattractive. And I don't think anyone is actually asking for that.
Yeah, I guess it comes to what we've seen the Department of Labor use this phrase a lot. A lot of people used it too, talking about the Trump administration's old rule, the chilling effect, right? It's that even if the words don't necessarily on their own imply that you shouldn't consider something, that people are worried, not knowing where the line is between I'm considering ESG for its ESG-ness, right, versus ESG for its expected financial impact. And so I guess I'm curious, John, for your thoughts about that. Even though we don't think that any states really, I think if they were talking about it correctly, would say, we want you to ignore data you believe is going to have a material financial impact on the investments that you make for us. But how do you sort of square that with worry about not knowing, especially at the risk of what happens if you've made an investment which ultimately turns out not to perform well? how do you square that with worries that somebody from one of the states would say to you, well, looks like you invested in this, this company that was emphasizing ESG a lot and it didn't perform well?
I think that this gets back to process. I think in terms of an investment management firm having a detailed process to base its decisions on and base its analysis of materiality and utility within the investment process. I think one of the impacts of what we're kind of seeing and the issues being raised around ESG is that firms that have a detailed process, a well-developed institutional investment process built specifically around ESG will be a lot more comfortable staying with it and executing. And firms that have come into it recently or have not made the commitment to the systems and process necessary to make the very decisions that you're asking about, Josh, will have to take a step back and probably retool in order to be in the business. So the point that you're making, which is that the risk associated with problems in this area has either the impression of that risk has been escalated or the reality of that risk has been escalated. I think that all of us will drop back to, is our process, is our documentation kind of strong enough to withstand an increased risk environment? I think that's the reality of it.
I mean, that's a great point, such a bedrock point, right? When thinking about retirement assets too, of course, that prudence is process. The Department of Labor has said that for decades, and I think it's a great point that continues to ring true, even in this what feels like a very new debate. That sort of the old answer is really the right answer, have the right process. Taking that from like a little bit of a different perspective, though, Kevin, if we think about the data, right? I think even if we wanted to say, all right, well, we're worried because of the chilling effect, we're actually worried about how much ESG data we're using. I mean, how would you even really try to do that, right? How would you define, this is our ESG data we can look at, this is our non-ESG data that we look at? Like, how would you even do that?
I think it'd be very messy for a couple of different reasons. One scenario could be that states designate specific categories of information that asset managers are now banned from considering. But then if that's the case, well, there's a lot of blurred lines there, right? So is now, I used the example of governance before, now can I not consider whether the company has independent directors or not, right? Is that banned? Or, for example, the company's reputation because of how it interacts with its communities, is that now banned? Like, what's the line between just simply good investment research from these types of issues? So that becomes a huge challenge. Another challenge, I think, which has come up more recently is that I think the most advanced ESG data that is being put on the market now is based on AI and natural language processing. So you're seeing more and more of these data providers like True Value Labs and the like. And the question then becomes, well, it goes back to what you said earlier about enforcement, right? So if I'm using natural language processing or AI, is a regulator really going to be able to detect my use of that information and then prevent me from using that information? And if it's AI as well, it may be that I'm using a model which I'm not really supervising. So it could be an unsupervised AI, which picks up on financially material ESG factors as part of its search process, right? And then it's a matter of, well, am I actively considering ESG factors, or is it that my AI, which is part of my broader investment process, doing that for me, right? That's something that I can't imagine regulators, looking under the hood and really trying to disentangle. And so I think back to my days as a portfolio manager. I had a portfolio which had about 5,000 securities in it, right? Very complex portfolio. And going back to what Patrick said before about running separate portfolios, separate sleeves, it's a lot of work to do that. It's huge administrative burden. It gets passed on as costs to the client. It potentially opens up the risk of more mistakes being made. So again, extra diligence needing to be made. And then also going back to your point before about, well, will asset managers then have specific products for blue state and red state? At the end of the day, if I'm in a red state and I see an asset manager doing a different product in a blue state, well, I'll probably just ban the asset manager outright, right? Rather than saying, oh, certain of your products can be used here. So yeah, I think once you get into the detail of what this means on the ground, I wonder whether it's actually enforceable.
That's a good point about like the sort of challenges of actually being able to sort of suss it out, even if you were to try. I mean, also just sort of like, picking up again on that point about different products for different regions. I mean, even stepping outside the US for a moment, right? This is a big, divide between obviously in the EU, where this entire discussion that we're having sounds completely insane, right? Because SFDR is so ingrained at this point, and it's sort of accepted as bedrock that sustainability will be incorporated into investment management and investment decisions to various degrees. And it's really just a matter of how much is incorporated, not whether to do it or not. But I think that it's another place where it poses challenges about if I'm marketing the same product in Europe under SFDR, and I have actually made certain undertakings, and I'm running a parallel product in the US. And of course, I'm not making the SFDR undertakings because I don't have to. But yeah, I think it does bring up some challenges about how do I really show that they're different, short of being able to really document some real differences. And so I think it comes to, and John, this is a point you made earlier. But it sort of comes to the question about just like product availability, right? That at some point, managers, including the investment professionals at the states, you think really have to be able to just say, we like the return profile of this product, right? And we like the industry and sector focuses, and we believe that this is a product that's appropriate for us to invest in, notwithstanding. And sure, it might incorporate ESG to a certain extent, but we, the state investment professionals, are not investing in it in order to advance whatever ESG goals may collaterally be advanced by it. We just think that this is a good investment for us, the same way that other investors all over the world do. I'm curious, John, what's your reaction to that?
I think that's right. And again, kind of coming back to the concept of changes that are happening in the world around us, companies' ability to adapt to that, and investment managers' ability to analyze that and understand which companies are able to do it in a way that drives long-term value creation. And of course, for so many firms that are in the ESG space, that's what the research is really all about. And one thing that it really brings to mind, Josh, is that the investment management industry, whether it's the ESG niche or the entire industry, has done a poor job really creating clarity around ESG. We've had a problem in the industry with creating strong definitions and creating clarity in terms of what this means and what it means to investors. And I think that it's important that kind of all of us listen to what the red states are saying and understand why they're saying it. Now, Patrick, you're doing your research and you're going to have quite a bit of information to share about that. But there are valid points on both sides of this debate. And of course, the way a democratic capitalist society works is both sides get to make their point. At the end of the day, though, investors need to have competitive financial results. So at the end of the day, it really all needs to be put to the side in a strong definition of ESG materiality and how that is utilized in an investment process needs to be created with a focus on serving the investor needs, which is always competitive financial returns. And frankly, I don't want to get into a discussion on SFDR because I think that's a whole different point. But still, at the end of the day, people in the EU also want competitive financial returns. So I do think there will be utility kind of across borders in terms of having kind of the strong definition of ESG based on, kind of financially material information used in investment processes to drive competitive results. And that will work kind of across all markets.
It's a really, really great point. And also just, following up on what you said about listening to both sides, right? And about there being valid points on both sides. Question just came in from the audience, which I think is pretty relevant, right? Is that, the same way that we do see, obviously we see these boycott lists only coming up on sort of the red states as of right now. And while we see less sort of affirmatively pro ESG activity out of the blue states, Illinois is sort of an outlier because Illinois actually has adopted as a preference in some cases for hiring ESG focused managers. And we've got some states that are doing some like enhanced reporting across their portfolios of ESG impacts across the totality of their holdings. But we do have the blue states that have their divestment requirements, right? We have Maine with the large fossil fuel companies. We have, the comptroller in New York City, addressing the same topic. We have, while it's maybe not as politically motivated versus, motivated by obviously tragic past, but in Connecticut we have, divestiture from firearms manufacturing. And so, I guess, and this is a question I really do open up to everybody. Sort of, there is that other side to this, right? About if we're just talking about investment returns, then divestment from a block of companies doesn't necessarily make sense.
I agree with that. And you didn't mention tobacco, but
Well, I was going to say, yeah, that's
that,
what I was going to mention.
there you go, Patrick. And then we could go back to the Sullivan principles in the 1980s around South Africa, where there were certain legislatures that, required the adoption there. I agree, divestment doesn't really make sense. And again, back to, my point, companies evolve. And generally speaking, what investors are interested in is driving positive change, seeing improvement. And just from a kind of a philosophical point of view, avoiding problems doesn't really get us anywhere. Working to drive long-term value creation is really how companies are supposed to interact with issuers. So divestment in that case is really not part of a typical investment process. So divestment makes a political statement. I'm not a fan of it. And I think most investors and most of us would prefer to see investment decisions made based on what's happening at a company today, engaging with companies to try to drive long-term value creation, and always be hopeful for improvement within our capitalist system, for sure.
I'll just pick up one quick point on tobacco, because CalPERS, I forget which one, it might have been both, but divested from tobacco companies, and they would get beat up by the conservatives saying, you left, your returns were less because you weren't invested in tobacco companies. But, and it comes up in the Europeans too, if you are paying for healthcare or have to pay for healthcare because you're this state or this government, and smokers are getting sick, you're going to end up paying for those sick smokers because they can't work, or because they might even have to go on disabilities or whatever those longer term costs might be. So it's these externalities that might, and the time horizon, which might add up to your costs, which can make the argument for divesting from something like tobacco.
And that's an important difference, I think, actually, between states versus private employers when we think about this, right? Because we think about alignment a lot between the duties on private employers for their pension plans, which are only allowed to invest based on seeking returns for the plans, right? But the states, even though they've modeled on RISA, right, as we said at the beginning, the states really, they're within their rights to advance policy goals. And actually states have advanced all sorts of policy goals for their pensions for decades, whether it's express prohibitions on investing with companies that participate in like the BDS movement, or whether it's express requirements to hire locally or to invest locally before investing, outside of the state, or whether there's certain protected industries where they require investments to be within the state, not within the state. There's all sorts of things that have actually been on the books for years. They just haven't caused the same level of concern, in part because they haven't been, in my view at least, because they haven't been as politically motivated, but also because they've impacted probably a smaller portion of the investment universe than something broad like ESG and the pecuniary or non-pecuniary factors. But I think that that when you talk about something like smoking, you can also sort of, the corollary of that is, maybe a state like Louisiana is within its rights to say, we don't support divestment from the fossil fuels industry because of its importance to the state. But then the question, I think, sort of becomes, why are they doing it by having the state attorney general say that it's inconsistent with the fiduciary duties to the retirement plan to do that, versus actually talking more about this broader conception of cost to the state? I don't think anyone's going to have an answer to that question, of course, and I won't put anybody on the spot to try
Thank
to
you.
poke holes in the Louisiana AG's reasoning. I think that it's in this example, of course, but I think it's interesting, sort of going back to the vocabulary. It's also sort of about the range of the discussion. The discussion has become sort of so wide ranging that in some cases, I think it can be helpful to step back and actually say, well, maybe in some cases the state should say, we want to protect X industry, not just based on what we think is best for the returns of our retirement plans, but because we actually affirmatively are saying to those state retirement professionals, we want you to sort of, ironically follow a dual mandate, right, of both trying to grow the returns of the state plan, but also of protecting the broader economic interests of the state.
Well, Josh, you're the ERISA expert, and you can lead us back to the DOL's thinking on the union policies in that regard.
That could be an entire discussion on its own, but yeah, no, it's a great point, John. There's a long history in both camps of having concerns over some of those policy considerations as well. Sort of picking up from this, like a slightly different point, but I want to get this before we're done. These red state restrictions, like we're talking about them really just in terms of limiting ESG, but the way they're written, to John's point before, it's materiality versus non-materiality. It seems like any consideration of anything other than sort of what you believe to be material economic returns ought to be problematic. And so, Patrick, I'm curious for your thoughts on this. What does this whole trend mean for for one of the sort of expressly anti-woke or anti-ESG managers that's out there in the market now?
So somebody like Stride.
Yeah, that's right.
I mean, that's a great question, and sort of kind of exposes a little bit of absurdity of the argument. So if you look at Stride's voting, I pulled it up here. They voted against Tim Cook at Apple, one of the best performing companies over the last few years. And how do you make that case? Well, Tim Cook parties with the Democrats. I mean, what is that, a pecuniary factor? So but you're never going to see Stride banned because he's in with the Federalist Society. So it just does, it sort of, I don't know if that answers your question, but it's just a fun example of sort of like how the conversation can get a little, the arguments against it can get a little absurd pretty quickly when you scrape below the surface.
Yeah, it's a good point. Shifting gears a little bit, I think we'd be remiss if we didn't talk. We've been talking about investing this whole time, right? And of course, it makes a lot of sense. Talking about asset manager, we're talking to an audience mostly of asset managers, investment professionals, but we really can't, have a discussion like this without also talking about proxy voting. It's become such a major political issue. It's become an issue in a lot of the red state laws. It's obviously one of the topics that is being discussed a lot during ESG month in the House. Kevin, would you like to talk to us? Could you just very briefly, share your thoughts based on your research on, what's really, what you think the outcome of these proxy voting restrictions may be?
There's a few different things going on there. So I think there's been a lot of reporting on pushback on, especially on issues like companies' climate transition plans and other measures designed to support workers and communities that are viewed as pro ESG. And we're seeing some anecdotal evidence of lower proxy vote support for shareholder proposals that are trying to encourage companies to focus on those issues. But one thing, or a couple of things to think about there is that those headlines don't tell the full story. So, for example, it doesn't take into account that, so in 2022, you had a lot of these proposals being withdrawn prior to going to a vote. And what that means is that the companies actually agreed to adopt these measures, these pro ESG measures. And so they're not even getting to a vote. So what you're left with are those proposals where there's likely to be more pushback because they're more challenging for the company to actually implement in the first place. So that's one thing to consider, is how many of these proposals are actually withdrawn. It also doesn't take into account the nature of the demands being put or being asked by shareholders. So, for example, going back 5 years on climate, it's all about climate disclosure, right? So what are your carbon emissions? Whereas now it's more about what targets are you setting to reduce your emissions? At what date are you trying to hit net zero? Those are more challenging for companies to face. And then, so I can understand why there might be some more pushback on that. So it's probably a little too overly simplistic to say that the lower support for these proxy votes is necessarily due to the anti-ESG movement, but yeah, there might be that chilling effect that's coming about there. Just two more points on this. One is that we are seeing the rise in shareholder proposals being filed by conservative groups that are trying to go the other way. So they're trying to encourage companies to focus less on ESG issues. But interestingly, we're not seeing much support for those votes because they might actually be harmful for the financial performance of these companies, and there often isn't a clear business case for that. And then finally, you have seen the highest profile asset manager implementing what's called voter choice is BlackRock, right? So they're allowing investors in their funds to choose the proxy votes for their portion of the fund, right? Fine, but I often then think, well, what are you as the pension fund paying your asset manager for? Like, aren't you paying for their expertise to judge which way they should vote on your behalf? Can I, as a pension fund that's invested in a Russell 3000 fund, can I really make an informed choice on 3,000 companies and however many votes are there? So that could become something more significant and more common, but I do question whether it's actually useful for investors at the end of the day.
That's a really good point. John, I'm curious, day to day, like in practice, how has all of this activity actually, like, has it impacted how you're evaluating proxy decisions at all? Or are you just going through the same analysis you always have done? Is a lot of this more sort of on the noise side, would you say?
We're certainly going through the same analysis that we always have, but to be clear, that analysis is updated continuously because things are changing and evolving. As Kevin rightly pointed out, we're in an environment where companies are increasing the amount of disclosure they make regarding what they consider to be material ESG factors, a fairly significant increase in that amount of disclosure just over the past 18 months, which of course is completely inconsistent with an ESG pushback. I mean, what's happening in reality is companies are experiencing greater risk associated with climate and environment and certain human capital factors. They're choosing to disclose it. They're choosing to take action to try to mitigate it. And so that's the reality. That's what's happening in corporate America because of what's happening in the real world around us. And I think that is really what informs our thinking on proxy voting. What are the issues that we should be looking to companies to kind of adopt into their practices and what's coming up for proxy vote. So however, I am respectful of the fact that what we heard at the House yesterday was a real focus on regulating, proxy advisors and a real focus on proxy voting. This isn't new. And I think what's important is that investment management firms, again, just like ESG research, investment management firms who are voting proxies for clients really need to have a strong basis, a strong process, a strong set of policies for why they're voting proxies the way that they are, and not simply rely on the advice of others. And these things need to be thought through specifically, company to company, issue to issue. And again, just for emphasis, this is a very dynamic area. Things are changing, companies are adopting, companies are changing capital spending budgets, changing practices. These are policies and procedures that need to be updated very regularly, just to keep up with the changes that are happening around us.
That's a really helpful, and I think it's a really great nuanced answer. It's clearly, it takes a lot of thought and a lot of work to really be able to respond to the current environment. Sort of as a,
Just to
go ahead,
jump in
Patrick.
on the proxy advisors, because I covered the heck out of this stuff to John's point, this is not a new conversation, and they've kind of been shoehorned into the ESG fight. Proxy advisors have been a hobby horse for the Chamber of Commerce and National Association of Manufacturers for well over 10 years. Why? Because occasionally the proxy advisors will vote or recommend voting for Carl Icahn and other shareholder activists, which corporate America would rather they didn't exist. Will sometimes recommend voting against pay plans. Will sometimes recommend splitting up CEO and chairman roles. So for these reasons, the companies don't like the proxy advisors, and now they have again been whipped up into the ESG debate.
I mean, the coverage, I think it's been fascinating, and it's just a great point about how it's sort of all gotten pulled together, sort of going to also the general idea about how the anti-woke and ESG are getting pulled together into this one sort of super debate.
And if you didn't listen to it, and just to finish that thought, if the proxy advisors went away and all you had was just the company recommendations, and you just voted all the directors, all the pay, all the shareholders, no matter what the companies said, well, who does that benefit? It benefits the companies, and then who does that not benefit is the asset managers who are responsible for being a check on these companies for their investors.
It's a really good point. And also, if I'm a fiduciary to a plan, tell me that I'm now stuck voting everything by myself, it's not just a question of, well, what are you paying the asset managers for? It's also, I'm going to have to either pay a lot of money in order to develop the expertise to be able to evaluate all these proxy voting proposals, or I'm going to be at risk of sort of squandering what's otherwise supposed to be a valuable right that's part of ownership of the security. So no easy answers on that one, I would say, as is the case for everything that we've been discussing. I know that we're almost at time. There's a couple other things I wanted to try to hit briefly before just wrapping up. John, I'm just sort of going to, you gave that very helpful answer about how you're actually seeing all the proxy pushback translate into the real world in your proxy voting process. I'm also curious to see, how much are you seeing of new restrictions that have been in place at red states actually translating into changes in allocations from those red states? Are we seeing them, are you aware of them terminating mandates, or not renewing things they might otherwise have? Or does it seem like in a lot of cases it's really more about just being extra careful to prove out and demonstrate that everything you are considering that's ESG related really is material?
Well, first, I think it's early days. And it's probably too soon to really have a full view of what states are going to do. And we've all seen reports to the media of some high profile changes that some states have made, but that is not something that we are experiencing, and that's not something that we're hearing about or seeing as a trend. And again, as we've said a number of times, the actual policy agenda of the ESG working group in the House and what the states are actually putting on paper is really suggesting that they want to eliminate the use of non-pecuniary ESG factors. And we just don't know of institutional investment firms who are spending any real time thinking about non-pecuniary ESG factors. So if they stick with that, we would not expect a lot of changes to be made in terms of allocations. And then just finally, I made the point earlier about activities that large corporations are undertaking to position themselves well for their business future as the global energy system transitions and transforms. Even some of the largest oil companies are changing their capital spending budgets because they think it makes good sense for the business. So this is a very dynamic situation, and that's why I say I think it's way too early to really tell what, if any, real world impact this will have on how states allocate their funds. They still want to have competitive returns. They're public, and companies are taking action. So kind of a lot more to this story.
That makes a lot of sense. And honestly, if they don't get those competitive returns, the only choices are ultimately going to be cut benefits to the retirees or raise taxes on the citizens of the states in order to make up the shortfall. So it's really important to them to be getting those competitive returns, of course. We've really just about reached the end of time. What I'd like to do is give each of you just 30 seconds to give me just like your sort of prediction for the future. What do you think happens over the course of the next 2 years in this space? Does it continue to escalate, steady state, totally different direction? Patrick, would you like to go first?
I think this split between having like ESG funds and non-ESG funds just isn't sustainable. And I mean, we've already seen this in Europe where we're going to more of a classification structure. This sort of like binary ESG, non-ESG, it just doesn't seem like this is going to be realistic in a couple of years. I don't know if it's as simple as just changing the names and taking ESG off the ESG funds, but that's what we're hearing from asset managers, is that this sort of divide isn't going to be realistic in the next few years.
Kevin, what's your final takeaway?
Unfortunately, I think that escalation is probably the most likely outcome in the next couple of years, as both as you have the reaction and the counter reaction from different sides of the debate. I can imagine and I expect that there'll be a lot of questioning of the arguments for the anti-ESG side. So what is the basis on which they're making these arguments? Is there any validity in those arguments? How can they prove that their view is going to be beneficial for plan beneficiaries? That the onus then becomes on that side of the debate, and you'll probably see a bit of back and forth on that.
Great. And John?
I agree with those comments, and anticipating continued discourse on both sides. From a investor's perspective, I do think it's important to respect and listen to both sides of this debate. I also think that it's critical to focus on, from my perspective, the outcomes within the investment management industry. So as that debate heats up and as some of the ESG factors become more financially material, I'm going to just go back to what I've said many times, kind of research rigor and process in terms of being able to verify the financial materiality of the things that one is looking at and using in investment decisions will continue to be important. And that I think is what we should all be focused on.
Okay, great. No, thank you all so much for the perspectives and for this really illuminating discussion. I personally found it to be absolutely fascinating. I'm sure that our audience has as well. And I know we have received a number of questions, which unfortunately we were not able to get to because we had so much content to discuss. But I just want to really, really thank you all for joining us this afternoon. I want to thank everybody on the audience for listening, and I hope you all enjoyed this discussion as much as I did.
Gosh, thank you very much. to you and your colleagues a terrific discussion and very valuable. Clearly, this is an issue that continues to need more clarity, more consistency across the data. We talked last year about the rating agencies and the need for new steps there to align standards. So much more to come. I hope you'll all look for the recording. The recording of our past sessions on ESG are up on the Ropes and Gray website. Please find your way there and hit the links on those. We have two exciting sessions coming up this fall. One on the expanding use of real-world experience to supplement clinical data trials for the development of new drugs and health solutions. And that will be a terrifically timely session. And then another timely one at the end of the year in November on the application of AI in talent management and workforce issues, both the opportunities and the challenges and the risks. So thank you all for being part of this today. Thank you to Ropes and Gray and Northeastern's DeMoore McKim School of Business, and we will see you soon.